everyone, to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, we take a look at the recent paper published by SEBI around mutual funds, and in particular about the total expense ratios or TERs. SEBI's really had some interesting proposals and analysis based on, what it's seen in the market over the last few years, and has come out with this sort of consultation paper or opinion paper where it will now solicit feedback. So for that feedback, we have Deepak Shray here with us today to go through the various proposals and analysis in this paper and see what we think of it and what we can share. Oh, and just fair warning or full disclosure to everyone, we have our own application in to try and become one of these mutual fund houses or AMCs in the works. So, and fingers crossed we'll get it. So we are obviously an interested party in this whole scheme of things. So don't just view this as dispassionate analysis. So first, Deepak, welcome. And look, when we go through the whole list of proposals, and we'll do that, of course, during the course of this podcast, a lot of them seem to focus on the TER itself, the expense ratios and various tweaks or enhancements or whatever to that. So I think I'll just start with that as a basic building block. What is this concept of a TER and what does it include and what does it not?
Hey Shray, so it's good to have a more deeper view into some of these things, and we're so interested because, as you said, we've applied, but to get people to understand the concept of a TER. I know a lot of you who are listening are probably looking at this and saying, I know what this means, but let me just try and simplify it for people who don't. A mutual fund is simply someone who takes your money, invests it on your behalf, and charges a fee for doing so. This fee is effectively an expense ratio, but because now we in finance like to complicate everything, it's not just a fee. It contains a lot of components. And what does it include and what does it not include? You have to think of it as conceptually two separate entities. Now, when you invest in a mutual fund, you typically buy a mutual fund scheme. It's like they'll say it's a large cap fund. It's an Edelweiss large and mid cap fund. This is each of these are schemes. Now, a company like Edelweiss, like SBI, like HDFC Mutual Fund, these are actually called asset management companies. There are HDFC AMC, SBI AMC, and Edelweiss AMC, and so on. These are different entities from the mutual fund scheme that you're investing in. So you give your money into the scheme. The scheme is managed by the AMC, and the AMC charges the fee. Now, the fee that the AMC actually charges the scheme is only a part of its total expenses. There are lots of expenses that the scheme can have. Now, the scheme can have a part of its expenses as, say, SEBI fees, custodial charges, certain other distribution and marketing expenses. So, for instance, you get a statement every month. You can choose to get it on email. You can choose to get it on in a physical way. The cost of the physical courier, etc., our marketing or printing expenses. There is a cost for sending an email as well. That entire cost is part of the AMC cost. There's a custodial fee and so on. There's distribution. So, for instance, you buy a mutual fund from a bank. You buy a mutual fund from a distributor. Those distributors expect something else. They're not the ones managing your money. The actual money is being managed by HDFC AMC. It's not different from HDFC Bank. It's a different entity. So HDFC Bank will say, I want a commission. That distribution commission is also part of what the scheme pays out. So think of the scheme as an entity that pays out for whatever it's worth an expense for various subheads. One of the heads is it pays the AMC to manage the money. That's the basic cost of saying, oh, you've done all this research, you've paid your fund managers, you can collect a fee from us for that purpose. But then anything else that's related to the scheme itself is also charged as part of the expense ratio. Now, the reason why it's called a TER is supposed to be that all the expenses get added up and shown as a total expense ratio. Unfortunately, and because we in finance like to complicate things, we have created things that are part of expenses but are not part of the TER, because the TER, the expense ratio in India, has certain maximums that a fund can charge. But beyond those maximums, there are certain fees that are still invisible to you. That invisibility is like this. There's a GST on the total expense ratio. That is a separate expense. It's beyond whatever limits have been mentioned. There is a 0.3% is a payout for fund flows from the bottom 30 cities. That's basically, or it's actually called B30, but it's not bottom 30. It's actually anything outside of the top 30 is called the B30.
I think it's beyond 30.
Beyond 30, yeah, there you go. That's what it is. So beyond 30 cities. So that means if you get money from customers whose residence is not in the top 30 cities, you get to charge 0.3% more, or up to 0.3% more. And then if your fund has an exit load, in order to the fact is the exit load goes back into the fund, so it benefits all the other investors in the fund. But there are some exit level expenses for mutual funds, because they might have had some initial entry costs and all that stuff. So those costs can be recovered by charging 0.05% extra. That means it's only 5 bips. Now, you think of 5 bips as for every crore that they manage, 5,000 rupees is 5 bips. Similarly, now there are two important charges. Even all these GST and this B30 and exit load based payouts are also required to be revealed. So a fund needs to reveal its total expense ratio at a scheme level. It also needs to reveal the B30 payout, the 0.05% exit load payout if they're charging it extra, and the total GST that they're paying. There's one charge they're not even required to reveal, and that's the brokerage and transaction cost. So that means a typical brokerage would be, say, 0.1% for anything that they do. Another 0.1% may be paid for STT, for buying a stock and selling it on. So those costs are never even revealed to the end investor. They're capitalized, which means that if you bought something for 100 rupees, the mutual fund will say, oh, I actually bought it 100 rupees and 20 paisa because I paid that 0.2% extra. But then when I sell it for 200, I record it as I sold it for 199 rupees 60 paisa, which is that 0.2% less that they will have recorded. So these expenses are effectively capitalized. This is how the structure works. This is what TER is and total expense ratio. And as you can imagine, a lot of people who over time get more knowledgeable about mutual funds, they start asking how much is the mutual fund charging, and they look at the TER as a number that actually reflects what they might be paying as fees for the mutual funds, or so we hope. Because as we pass through this discussion on what TER is and what SEBI wants people to do, we will discover some interesting and perhaps shocking insights about the whole thing.
Well, when you were saying that, I mean, I sort of understood that the reason the mutual fund does what it does with the TERs, it's kind of saying, this is the money I earn. The TER is what I sort of take, which is why I'm not telling you what the GST is, because, well, look, I don't get that. And I'm not telling you what brokerage and STT are, because I don't get that. And you always know what you own anyway, because the NAV kind of captures that, and so what your things are worth. But I think that's what the mutual fund houses, either defense or understanding of TER might be, to explain the difference. But look, I mean, that's just my comment. Maybe I wanted to start getting back to the analysis SEBI did. So what is SEBI proposing? And maybe if you could think through the spirit of why they're proposing this. I mean, are the mutual funds or AMCs earning too much money or charging too much from customers? Is that why SEBI wants to introduce this to shake things up and change the industry?
Well, this is an interesting point, because even in the paper they reveal this, that at certain scale the margins earned by AMCs is a tremendous amount. So they actually talk about how the top 5 AMCs in the country are earning 70% plus gross margins, which means if they earn 100 rupees, they're probably making 70% EBITDA. I know they don't even have to adjust the EBITDA to make it 70%. It's just that ridiculously high. This has two structural reasons. One is that all the expenses related to a fund have to be expensed at the scheme level itself. The AMC only gets the fee for its management. That means if the AMC puts out an ad, and that ad says buy HDFC equity fund, the minute it says that, the ad for HDFC equity fund costs 2 crores, and that cost of 2 crores will go into the HDFC equity funds TER and will not be paid by the management company. It will be paid by the actual underlying scheme itself. However, the mutual fund itself is, it's a separate entity. So what happens is the AMC is a separate entity. So the AMC will charge a certain fee where now it doesn't have to advertise, it doesn't have to do anything, because it technically is getting only money for its fees. And if you have 100 analysts on your rolls, to get another 100 crores in AUM does not mean you have to hire another 10 analysts. That means your incremental cost of capital, of revenue, is very, very low. So that means that you have an economy of scale, and what effectively SEBI is saying is that you're making a lot of money, you guys. Can't you reduce the amount of money you make? And I know this is a very communist thought process, but they are actually saying you reduce the amount of money you guys make in order to benefit investors. Now, how much this will benefit because the whole set of changes that they've mentioned will probably bring down total AMC costs from, say, 0.5% to 0.4%. It's like a 0.1 or 0.2%. It's the equivalent of saying, oh, I love this fund when it makes 12.1% per year, but I hate this fund if it makes 12% per year. It doesn't seem to be one of those massive triggers that say, oh, if I only force these people to make less profit, everybody would rush into this industry. I think that thought process may be one of the reasons why it's altruistic, right? Everybody thinks that if I reduce costs, everybody will come rushing in. The answer is not so much. If the differential in cost is only 0.1%, it's meaningless. Like somebody told me, Deepak, you can't offer a 1% discount on a product. Because I was asking him, why don't people for UPI charge lesser in their stores? Say, I'll give you a 1% discount. He said, Deepak, nobody cares about a 1% discount. So I looked at him and said, but it's 1%. Then he said, you finance people have all screwed up in your heads that people care about 1%. People don't. In general, if you go to a shoe company and buy a 1,000 rupee shoe and tell him, I'll give it to you for 990 rupees just because you paid by UPI, it is not going to make the difference to the guy who's purchasing. So he will look at his credit card and say, yeah, fine, it's $10, I don't care. And maybe that's the equivalent of that is the 0.1%. The differential in TERs for introducing a massive regulation on an industry. In general, I would want more. And let me come back to some economics here.
So, look, I remember the first change that they kind of said, which we all agree, is just add this brokerage and transaction costs and GST, just put them all as part of TER. But you're not opposed to this, right? I mean,
No. In fact, I think that part of the proposal is brilliant in the sense that you should actually show total expenses. You should not hide those expenses. So if an actual expenses is 8%, I need to know that it's 8%. So let me make that decision on whether I want to continue to invest in the fund. But remember this, all return calculations are only after the total expenses are taken care of, including brokerage. That means if I get 14% on the return on the fund, when I sell it, I'm going to get that 14% minus some stamp duty or some STT. But I will actually not pay anything more to exit a fund other than the exit load that they have. So it's not like if you show me an NAV of 50 rupees, that if I sell it, you'll give me 40 rupees and say, I'm sorry that 50 rupees didn't include all these other costs. But when you're actually selling it, I'm going to have to reduce it and, sell it and give you the lower.
That's how AIFs work, right?
Oh, yeah, we discovered recently. But with those, that again is a different probably podcast by itself. But I believe that it's true that, you should reveal everything. So the brokerage extra. To give you an example of how complex that is, we'll come back to the other part of it. The point about brokerage being high is like this. Let's take, for instance, a fund, a flexi-cap fund. Now, average flexi-cap fund turnover ratios. That means if they had the turnover ratio is basically the lower of the total purchases or the total sales in a fund in a given year. So that means if you have sold nothing, your turnover ratio is 0. If you have sold 100 crores and your AUM was 500 crores, you have purchased 200 crores, then the lower of the two will be 100 crores on average AUM of 500, which is 20%. The average turnover ratio of the entire flexi-cap fund industry for the last 1 year has roughly about 135%. That means if they had 1,000 crores, they actually sold 1,350 crores. Now, how is that possible? You sold 650, bought something else, you sold another 650, bought something else, and so on. So you got 135% turnover. Now, 135% turnover is substantially high. So think about it another way. If I have 1,000 crores and I sold and bought 1,350 crores, because if whatever I've sold, I've had to buy back, right, at some point. That means I did 2,700 crores worth of transactions. 135 crore buy, 130 crore sell. Now, 0.1% of that is STT. So 0.1% of that is 2.7 crores, roughly, I think. Yeah, 2.7 crores. So that's 2.7 crores on 1,000 crore AUM. That's, well, I think that
I think
would
you might be off by a zero, no?
0.27%. No, it's
so let me do
roughly
0.27% into 2,000, right?
it's
No, you're right.
2,700.
2,000. No, I guess you're right, actually. Yeah.
2,700.
Yeah.
It's about 12. No, it's 0.27% into 1,000.
Yeah,
So
okay,
that's
2 yeah, no, you're
2.7
right. You're
crores.
right. Yeah.
So it's
you're right.
0.27% extra you're paying. Forget the brokerage. This is just STT. If the brokerage
Which
is
you can't
0.1%,
negotiate. This is flat for everyone.
this
of
is flat
course.
for everybody. You don't negotiate with the government saying I'll pay you less.
Good
right?
luck.
Very interesting other thing that comes out of it. But what's interesting about this is the STT, the transaction cost, since it doesn't reflect now, that when it does, you will look at funds with lower turnover ratios.
I hear you, but look, some of we have fairly sophisticated people in our office, I would like to think, and some of their favorite mutual, since we don't allow people to trade in stocks much because of all the obvious reasons, they end up doing mutual funds, which they're allowed to do, and they all are big fans of many of the quant mutual fund schemes, and I think many of them have their personal money there, and there I know the turnover ratios of some of them are extremely high, at least one of their factor ones. I mean, again, the people in our office know what's going on. They're saying, why do you care so much, Deepak? I'm making good money, right? At the end of it.
This is a great, brilliant point, and I think this is absolutely true. I think we shouldn't care, but we should know.
Okay.
So, once I get the returns, I don't care if you made it by selling something 6 times over or you made it by keeping the same thing for. Why is it's like saying my first salary, the amount of money I make from a salary is better than the money I make from, selling roses. It's the same money. If I make more money selling roses, your roses are doing you a better deal than your
Whatever
salary.
job is, yeah.
So it's not cleaner money if you do it from high turnover versus low turnover. But I do believe that you should know, because you should be able to make that difference out. And we need to go beyond those shallow arguments of TR and say the TR is already included in my calculations. I don't care. And here's the next part, and maybe we'll come to that in another part. TR changes over time. So
I'll pause you here one second. You had asked me to look up one example in a flexi cap. What was the largest flexi cap? So I found, well, according to Value Research, so please correct me if I'm wrong, but Kotak flexi cap is probably India's largest flexi cap fund. It has something like, again, this is slightly dated, 37,000 crores roughly in AUM. And I think the calculation I did when you told me was that, look, it'll be allowed something like 1.4245% based on that slab thing, and they're ending up charging 1.4 on the regular. So, I think you agreed that SEBI can get a little irritated with this, right?
yeah, no, it's very interesting. Okay, so the argument, I think, let me put some more context over here. There's a slab rate for every AMC. So let me just explain what the slab rate means. So the slab rate means that for the first 1,000 crores, you're allowed to charge 2.25%. For the next 1,500 crores, you're allowed to charge only 2%. So effectively, if you look at it like a fund that owns 37,000 crores, will go through each slab at different rates, and effectively the total rate of TER chargeable at the max, including your marketing, distributor commission and everything, is 1.42%. But this is India's largest fund, equity fund.
Active, right? I guess those passive ones might be a bit bigger.
Passive and hybrids are slightly better, bigger, but we won't come to those. If the largest Indian active pure equity fund is charging you 1.41 when they can only charge 1.42 at the maximum, then SEBI is right to say, listen, you have scale. You're the largest Indian mutual fund scheme, and you're charging literally exactly as much as I'm allowing any mutual fund. Any other fund that reaches 25,000 crores, 30,000 crores will probably have a 1.44 limit. They're charging 1.44. So if SEBI is looking at all of this and saying, listen, if your at that level, and yet you are charging close to whatever limits I've set. Are you guys really behaving in the right way? That's the thought process that comes over here, and maybe there's room for that kind of thinking to come in here, because I'm sure your question is probably like, why isn't competition coming and breaking things down, right? So I think we have to think of two very important points. First is the point about, I mentioned about this 0.1%. 0.1% is not going to make a difference. How much do the AMCs actually make out of this? There are two aspects to this. The TR includes distributor commissions. Roughly half or more than half of the AUM that comes from an equity fund is coming through distributors. The two big examples, by the way, which are not like that, are PPFS and Quant. Both of them get 61%, 60% plus of their AUM from direct. That means people find them and give them money. And this is not small amounts of money. I'm talking 35,000 crores in PPFS and 15, 16,000 crores in Quant. They get a significant amount of their AUM from the direct mode. But we'll come to direct and regular in a more detailed way later. But the regular mode pays out commissions. So this Kotak Multicap, for instance, how much do you think it makes as an AMC out of that 1.41% versus what it has to pay distributors?
So about half of that.
So you would think, but it's less than half. It is 0.56%, which means Kotak Multicap makes 0.56%, and the rest of this 1.4, which is nearly 0.8%, a little bit more than 0.8%, is going to distribution as commissions. The commission agents, which are typically the banks, the individual distributors, and the large distributors, they add up and make 0.8% plus of the commissions. What this regulation does is give you a total, but the difference largely is at the distributor commission earning end, not so much at this thing. Now you might say, okay, Deepak, the AMC has the benefit of scale. It has got to 37,000 crores. It's earning a lot of money on 37,000 crores. But any given distributor does not have 37,000 crores. It has maybe 10 crores. So a person who has an AUM of 10 crores and is making a commission of 0.8%, at 10 crores, 0.8% is
8 lakhs, I guess.
8 lakhs, which is probably less than the salary he would get if he worked at a job. And imagine he's got 10 crores worth of AUM. That means if each customer has invested a lakh of rupees, that's 1,000 customers for him, which is a lot to manage. So the small distributor is thinking, dude, 0.8%, mera to banta hai. Why? I get it. I need to earn that kind of money just to go there. But I would say this is definitely something we should address. The small distributor needs it and absolutely has to. In fact, has to get paid even more. But the large distributor should not. The banks that earn 700, 800 crores worth of commissions, they don't share this commission with their employees. They just give them targets and say, you have to earn so much. There are very, very large distributors who are responsible for AUMs worth 40, 50, 70,000 crores. Now, they have the benefits of scale. Why aren't they being dinged in a similar way by telling people, listen, you have slabs. Once you get to a distributor slab of so much, you can't get paid more than X amount. That X amount will then automatically bring down. So if you're regulating how much AMCs can charge, regulate how much distributors can charge. Of course, SEBI does have the problem that distributors are not directly regulated by it, but the AMCs are. They can always say the AMC commissions to distributors are regulated to that extent. That means you cannot. So if you're a small distributor that is making less than 100 crores of AUM, that's fine. But if you have more than 100 crores of AUM, your distribution commissions go down. And it will go down over time as the slab becomes higher and higher and higher. And I think there is a reason for a good reason for us to say, don't pay someone who has 5,000 crores the same as you pay someone who has only 10 crores or 50 crores. I think you can go down to the sub-distributor level for this.
Again, your point is well taken. I mean, that if you're trying to address costs, you were saying that if you just try and with your TER stuff, you'll bring down costs by 0.1, 0.2. But here, clearly, the room is significantly more, and you will probably achieve a greater savings if you can target the large distributors, not the small.
Yes, and what will happen here is typically the problem is, if you allow distributors to take a lower commission, or make distributors take a lower commission. Wouldn't it just be that the AMC then charges a higher fee? They're like, okay, you know what, I'm paying the distributor less, let me charge higher instead. They could do that. But if you really want to target a lowering of total cost, then going down the distributor rate may be more effective in terms of lowering the total percentage being charged and limiting the amount the AMC can charge separately as well. So that is the other thing that you want to, if that's what you want to achieve. Let me ask you this: from even if the 0.56% that Kotak AMC direct plan charges for the multi-cap, for the flexi cap, yeah. Out of that 0.56%, so 0.44% actually goes to the AMC. The remaining 0.12% is other costs, the SEBI, this. So 0.44% is what Kotak Mutual Fund, Kotak AMC makes from the Kotak Flexi Cap Mutual Fund. I would say this: what will you reduce this to?
It seems quite low to begin with.
It's 0.44. So maybe you'll reduce it to 0.3. If you reduce it to 0.3, the end customer, that means you have taken 1/3 of Kotak's revenue away from this fund. Even by doing that, how much have you increased the customer's revenue? You have reduced it from 0.44 to 0.3. Kotak makes less money. The customers don't value the extra 0.14% that they make. In 10 years, they will make 1.4% more. In 10 years, nobody cares about 1.4%, right? So nobody cares about 1% for a shoe. Nobody's going to care about 1.5% over 10 years. So I don't think this is meaningful. But the transparency aspect is well taken. In fact, transparency is so important that, TERs can change every day. And SEBI has actually introduced a law that requires mutual funds to reveal their TERs every day. How many people actually look at it? The answer is almost nobody. We're in the process of putting a post out. If you look at the difference in TERs and how many times certain companies change their TER, just the changes in TER can be as much as 35, 36 times in a year.
So that's like every other week, basically.
Literally. And you could literally have a fund that reduces its rate towards the end of a month and increases it again in the beginning of the next month. And there have been such cases where and I'm not talking small numbers. I'm talking like there's a fund recently called Aditya Birla Liquid Fund. Now, you would think a liquid fund is not going to have a huge amount of expenses, but recently they've increased their liquid fund TER from 0.2% to 0.37%, which is ridiculously huge. And I would say people need to be aware of this, but right now this awareness is, the data is all there, but that awareness is going to... So what happens in a liquid fund is that it's not really that the fund management is so great that you'll make 0.17% more. People who look at liquid funds look at this kind of stuff very carefully. And for them, they understand that here the increase in costs will directly result in a lowering of returns for them. Now, if you look at the guys who invest in liquid funds, they make maybe 6% a year. For them, an increase, that means if I put 100 crores, I'll make 6 crores. If you increase your fees by 0.17%, which is what they've done so far, 0.22, 0.39. So if you increase your fees by 0.15% or something like that, I will actually make, instead of 6 crores, I will make 5.82 crores, right? So I'll make 18 lakh rupees less for 100 crores of this thing. Now, this 18 lakh rupee less can be a significant deterrent for a corporate who's looking at parking. It's like, why should I lose 18 lakhs? 18 lakhs is the cost of, I don't know, maybe
one or two people or something.
One or two people. So they will look at this carefully and say, this is how it is. But this happens in equity funds all the time. In equity funds, you don't even have the luxury of being able to get out, because if you get out early, you have an exit load. If you get out early, you have taxation implications because you have to pay 15% tax versus 10% tax. So you can't just make that shift. Corporates don't necessarily care about taxes, and they don't have exit loads in most liquid funds anyway. So other than the first 7 days, so they will be more reactive and therefore change when there is a process like that. But TR changes happen so often on a liquid fund that I think even the disclosure that a TR has changed has not going to do enough to, other than introduce helplessness in the name in a customer's this thing. I'll give you an example. Many of these liquid funds and not liquid equity funds have exit loads of 4%. So if you have a 4% exit load, then why will I exit paying you a 4% fee in order just because you increase your TR by 0.2%? Now, I'll make that trade-off and say, you know what, I know this is bad of them to increase by TR by 2.2%, but I won't get out because they have an exit load. So it doesn't necessarily mean that there is going to be a stick and a carrot. So if you offer something bad, they may not be a stick against you. But still, I think, economically having more information available to people will help them prompt action of some sort, and therefore give feedback to the people who are making these changes that these changes are not desirable. So I think my limited point is attacking AMC's profit is not necessarily going to be a good thing, but I am definitely in favor of all disclosure.
Fair. Disclosure, you should know what you're paying, even if it's not to the MC, even if it's to someone else. I do get that.
No, we have crazy levels of disclosure in the PMS. So we actually show every single type of fee. And I think it's a good thing. Although customers are looking at us and saying, why are you paying so much fees? Well, you know what? We disaggregated them. What you pay us is so much. What you pay STT is so much. What you pay brokerage is so much. We have the lowest brokerage cost in the country on PMSs. And I won't say what it is and how much it is because it is competitive stuff. But the point is, it is one of the lowest fees, and we've negotiated that so that our customers make better returns. And because we reveal it to customers, they are aware of exactly how much they're paying for their brokerage.
I'll move to the next point that I found very meaningful in the SEBI thing. It was like you can have this limited purpose trading membership created for AMCs so that they can directly trade on the exchange. Any thoughts on this?
Oh yeah, I love this idea. Now, see, if you look at what AMCs do, there is hardly any risky part of what they do, in the sense that they cannot trade unless the custodian allows them to trade, and they will only be allowed to trade with the balances that they actually have. That means a mutual fund cannot do intraday buys or intraday sells. They have to have money in their bank before they buy. They have to be able to settle that trade, even if it means settle it in the next hour. That money should literally be in the bank. That way, they pose a very small risk to the overall brokerage part of the system. There is also a very, very good reason to do it. Reduce your brokerage to nearly zero. Now, there has been one big problem, and why is SEBI introducing this? Think of yourself as a broker. You're looking at a mutual fund that says, I'll transact with you. Well, I'll do 100 or 500 crores of transactions per year with you. So let's say 500 crores of transactions. You're thinking, listen, this guy, this Deepak Shray, he wants a bunch of research reports so that he can buy or sell stocks. So they employ a research team, and they send me a bunch of reports. Now, I look at a bunch of reports and say, well, you know what? This company is great. I like this. This brokerage sent me this report. So let's route, say, 200 crores of brokerage to 200 crores of activity through them. Now, this introduces two complications. And the first one is the more obvious one. What is the broker charging me? They're not charging me for the research. They say the research is free. But I'm going to charge you 0.1% brokerage. Now, I'm looking at this and saying, dude, 0.1% of 200 crores is roughly 20 lakhs. This is a lot of money to pay as brokerage for a transaction where I'm just buying stocks on an exchange. I mean, come on, don't tell me that much. But you're looking at me and saying, no. All this research is coming to you free. Why don't you take it? And anyway, up to 0.12%, which is the fee at which SEBI says 0.12% worth of transaction cost is allowable without any disclosure in TER. So up to 0.12% is there. Why don't you just pay that? Anyway, you're not the one paying it. Your investors are the one paying it, and, it's fine. I think that is a little unfair. I think customers you need to have an incentive to optimize for brokerage. And second thing, if the asset manager is charging the fund a fee to manage the company, why isn't the research cost theirs? Why should they be paying a brokerage through the investor for research? There's something called a soft dollar arrangement where you can say, listen, charge me a very low brokerage, please, but I will pay you a separate 40 lakhs per year or 20 lakhs per year as a fee to get your research. This is perfectly valid. This is exactly how it should be. You should absolutely compensate the broker separately for the research and pay for the brokerage. Now, we negotiate with a lot of low-cost brokerages. We go to the wire. We say, we are doing all the research. Don't give us any research. Our research is all ours. So can you please tell us the lowest brokerage you can charge? And you know what? They come down to ridiculously low levels. As much as, as low as, I won't name exact numbers, but the problem with not having this kind of a soft dollar arrangement is, people say the soft dollar arrangements are a bad idea, but my answer is no. If I can negotiate down brokerage, I can pay the broker whatever else I want from my fee. If I'm charging a fee as an AMC to a fund, then what I do with that money, whether I spend it on research or I hire the analyst or I outsource the analysis to somebody else, is my problem. But I'm going to pay that out of my fee. I'm not going to charge the fund a separate fee out of that. So therefore, the brokerage part is out. So if an AMC were to be its own broker, it would not have to pay that brokerage, and therefore any broker that wants to offer research would literally have to charge for that research directly, which is fair. Now, here's the part which I think becomes tricky to elucidate. But when you tell a broker that you like a stock and you're going to buy 200 crores worth of that stock, the broker has this information, and often it is used for front running, which means you call up the broker in the morning and say, listen, get me 100 crores of this stock somehow. The broker is going to, many brokers, I'm not saying all brokers do this, but many brokers are simply, since they're privy to that information, and you're not the one placing the order, your dealer is just calling up the brokerage and saying, do this. The broker themselves has the opportunity to say, listen, I got these 10 or 6 customers who are very close to me, or who I want to impress or whatever. Let's buy it in their accounts first and then execute the orders for the mutual fund. So this is front running. This is a classic front running, but you can't identify what is front running at a brokerage. A brokerage may have thousands and thousands of customers. There's no way for you to prove that some customer didn't call you first, because they'll just call up the customer and say, sir, we have khabar that some big party is buying the stock. So he'll say, fine, buy it for me. So you do the buy for him, and then you go and execute this on your own self. Of course, many of these things are illegal to do, but they're done. They're more often than not very common to do. If an AMC were to be its own broker, it would avoid this conflict of interest of giving this information to a third party. It would be able to execute by its own, and the operation will be relatively low cost, because you'll have to build some expertise in-house. I think the relative cost of that is very low. But you would have very low risk because you don't have a lot of margin trades, and you don't have to pay. You have early pain. You don't have to worry about margins. You don't have to worry about intraday squaring off, giving customers, margins. All brokers are exposed to that. Now, for instance, if I'm a mutual fund, I've traded through a broker. He's supposed to deliver me some shares, and for whatever reason that broker goes bust, those shares remain in limbo at least for a while, maybe 1 or 2 days, and until SEBI's figured out what to do with that broker. Now, it's not happened yet, but it's likely to happen at some point, that brokers go bust, and then mutual funds who have bought or sold through those brokers also get hurt in some kind of way. So you avoid that situation as well, because the reason those brokers went bust is because they've given too many loans to their customers. Those customers couldn't pay back, therefore the broker couldn't pay back their loans, and therefore they went bust. So you avoid all of that situation and then go directly. I think you can also control volumes better. You can reduce your front running and simply reduce the load on brokers. Brokers will hate this because...
I mean, I assume one counter argument is that block deals and stuff like that, you don't have the expertise to do all this. We do. So if you want to go and buy 300 crores of said stock because you're just a huge mutual fund, you just can't do this. And I, who have been doing this for decades, can actually do this for you.
I would agree in general. And unfortunately, the problem with this is the block negotiations tend to happen between mutual funds anyhow through a broker network. That means the brokers themselves get to know, I have so many. So one of the reasons why is, for instance, one of the problems is if I'm a mutual fund, then we're a capital mind mutual fund, and we want to sell some stock. And we call up our broker and say we want to sell this stock. The broker is going to be like, he wants to sell this stock. I'm not going to ask why. I'm just going to find out from any of the other mutual funds I know. And so maybe he calls up, say, Edelweiss Mutual Fund, say, you know what, I won't tell you who, but somebody wants to sell this stock. Do you want to buy it? So, yeah, we've been looking to buy this for a while. How much is it? 100 crore block? Yeah, that's fine. I'll buy it. Now, they don't get to know that it's Capital Man Mutual Fund that's trying to sell. This thing, the broker keeps that one level of separation, right? So, you're right in that. And as long as that one level of separation is important. But today, almost everything happens free for all on the exchange. It's available. Volumes are available on the exchange, and perhaps for larger ticket sizes, you might have an excuse of being able to use third-party brokers. As long as you pay them, so maybe you can have 70 or 80% of your volume run on your own brokerage and 20% run externally. So for those of not great orders, you can even execute your trade algorithmically, because markets are liquid and deep now for the most part. You can execute most orders in at least many of the large cap stocks through the exchange, no matter how much you have to sell. Even if some stocks like HDFC trades over, I think, 1,000 crores a day sometimes. So I don't know if a mutual fund that suddenly has like 700,000 crores worth of this thing to sell, but when those big numbers come, you can always use them through brokers. The smaller numbers you should be able to execute on your own.
Another point I saw in the paper was, so do away with this whole B30, beyond 30 extra charger payout, and also get rid of that 5 basis points you were talking about on the what you can keep as a fund from exit loads and so on. Do you feel these are good ideas, or that they will help the ecosystem?
I think these are temporary anyways. So now what would happen is, if I have an address proof of anything that is beyond Bangalore, by the way, I come in Bangalore rural now because of where I stay. So I might actually qualify as a B30. I'm not sure, but I'm just thinking. If I do, then the mutual fund distributor is going to love me, and he's going to be like, dude, come, if I take you to money from you, then I will make a higher commission because this 0.3% extra is there. So a lot of times it's just abused by finding people who have appropriate addresses and moving money there at different points in time. The 0.05% is even more interesting, because now Kotak, now they're respectable AMC, but they have been charging this 5% in full on both their direct and regular plans. Now, why does the 37,000 crore AUM AMC have any costs of any sort result that are not applicable to a fund that does not charge an exit load? Your cost is not selling, because anyway that selling cost is absorbed by the fund. Your cost is not anything else. It's just, so if, for instance, if I'm getting redemptions of say 5,000 crores, on those 5,000 crores, I'm allowed to charge 0.05 on the entire 37,000 crores, which sounds a little high in terms of the costs that are out there. So I would say, maybe not required. So just give me a total number, and I'll limit the total number. I understand where you're going with respect to having these costs, but just give me a total number. Let's not disaggregate it too much here.
Okay, well, now that you bring it up, they'll come to the perhaps the most controversial, at least to you, proposal in that scheme was, look, a large fund house, a Kotak, a HDFC or someone like that, and they launch a new scheme. They're saying, hey, scheme-wise P&L should be different. So if you launch a new scheme now, you're allowed to charge more on this new scheme. And even though your older funds may have hit their, like, you have to charge less than this one you can start at whatever it is, to north of 2%. And as it grows, you're obliged to bring this down. And the thinking was that, well, as I said, new scheme, let its economics, let it stand on its own. And you need some initial higher ability to charge for that. In the paper, they say that they feel this has led to some level of abuse, because then there's a lot of, when people launch new schemes and there's an NFO for it, a lot of the money for that NFO comes from other schemes of this, mutual fund house. So they have a feeling that this will mean that, your distributor or there is someone advising you who's trying to push you towards moving into this more expensive thing because they will make more money and so on. That was at least the tone or the tenor of the argument made. So in this, I think their first thing is they're limiting your ability to what you can charge. I mean, if you're a big fund house, you can only charge a smaller amount for your next scheme based on your total fund house's AUM, full stop. You don't get to launch a new scheme with a higher AUM. And the second thing is, when you do this switch from like an old scheme to a new scheme, you end up at some version of the lower of the two TERs and so on. So just thoughts on this.
Yeah. So these two proposals are interesting. The first proposal, I think, is basically, once you cross as an AMC itself a certain amount of AUM, so you cross 50,000 crores, then your new schemes cannot be launched at a higher fee. In fact, the problem that the way they've mentioned it in the paper is to simply say the total AMC based, the total TER, because now you're including the brokerage and the transaction cost and all that stuff in it, should be 2.55% up to 5,000 crores of AUM by an AMC, which means if you launch a new scheme, you have 2.55%, that's fine. It's later on as you cross 40, 50, 60,000 crores of equity level AUM, that the equity AUM slabs should come down. So you should be able to only charge a smaller amount. Now, I don't think it'll achieve an objective over here because the AMC fee is on the total AUM itself. It's a percentage of the larger AUM. You might actually find that people will be able to launch new funds still at higher things if they reduce the fee charge on something else. Maybe it'll help in that context, but it does not change the fact that you could still incentivize new schemes with higher TER by reducing the TER charge for some of the older schemes. Second one, the switching cost. The switching is, the idea is that they've given data. They've said, oh, you know what, some 50 or 80% of NFO transactions seem to be switches. That means are distributors switching from one fund to the other for the pure purpose of earning more commissions? Then we'll make you charge the lesser of the two commissions. The problem that they account to me is they haven't look at the concept. If I go and sell someone an NFO, it's a new fund offer. It's happening over a 10-day period. The guy is looking at me and saying, Deepak, I like this offer, but why am I keeping my money idle for 10 days? I'm like, sir, don't worry. I will invest your money in an overnight fund, a debt fund. That overnight fund will accrue interest for another 7 months, and then we will switch over the entire thing on the last day. So isn't that also included in their switch data? Which means a significant amount of switch data must be coming in from these debt or overnight funds. And we don't know the difference of whether the distributor actually switching from a different equity fund to this one, or is it switching just from a temporarily parked amount of money for this one. So I think both of these proposals need some thinking or rethinking. I would still say go with scheme specific numbers, and even if it means they will pay higher, how else do you promote a fund? I mean, you have to pay more commissions. And that's the way of life. It's just, if you have 100 funds to choose from, I have to give some incentive to that distributor to be able to do this. I can do it by charging a lower fee for myself. But if I give a higher distribution fee, that's going to reflect in the fund's returns 1 year down the line. So I know that I have a natural upper limit to how much fees I can pay a distributor. But I think some regulation here is in order. There has been tremendous abuse of this in the past.
Fine. You don't think this will solve it, but clearly something should be done. I think this might be my last one before we then wrap up, which is SEBI said that the long-awaited thing in Sandbox, let's now start figuring out how you can charge a performance fee if you beat some benchmark or something like that. Sounds interesting. I think just curious to hear what you have to say. We don't charge one in the PMS anyway, so to that extent, so far we are unbiased, I would say, in our valuation of this proposal.
Oh, yeah. So the fee, the problem with the performance fee is it kicks in at the worst possible time, I think. So because equity returns are bunched, you will get 1 year where you get 40% and then 2-3 years where you get like 7 or 8%. So typical performance fee is if you make 7%, then anything above that, I will charge you a performance fee on the returns greater than the hurdle rate. So if I make 25% and the hurdle rate is 7%, up to 7%, I charge you nothing. Above 7%, I will charge you on the whatever, the excesses, or maybe even including the first 7% also. So if I make 25%, I might charge you, say, 1/10 of those earnings. So I'll charge you 2.5% of the 25%, which means you're paying me a certain fee for the performance. This we found in the PMS is not very useful in long-only strategies. It tends to be a problem. And, even in their own data, they look at the funds and say, well, how many funds have beaten the benchmark? The answer seems to be, less than 50% have beaten the benchmark in their regular mode. In the direct mode, the 10-year horizon funds have done 66% of 10-year plus horizon funds have been able to beat their respective benchmarks. but only 44 or 45% of regular funds have been able to beat the benchmark, which means that after you pay for the commissions of the distributors that you buy it from, you've not beaten the index. So the answer is yes, we need to beat the index. And if you do beat the index, we're going to allow you to charge a certain performance fee. They're going to do this on a sandbox. The problem again with this is, of course, first problem is that going to take you a long time to get to know what the answer of this is. I think you should look at compounded returns. So if you say that the Nifty from the time you got in to the time you got out, it was 5 years, you get to charge a performance fee if this person leaves after the 5th year. Based on the compounded returns versus the Nifty. So let's say the benchmark was the Nifty and the Nifty did 12% and you did 14%. Then you get to charge a percentage of that excess too on a compounded basis over the last 5 years, not on a yearly basis. Because in the yearly basis thing, what happens is 1 year you'll find the Nifty does 40, the customer does 40, the customer does say 42. Because you have a high beta fund, or 40, you make 42%. That extra 2% is what you charge fees on. But the subsequent year, the Nifty may do plus 4%, you may do minus 5%. It's actually beaten, on a 2-year compounded, it's not beaten, but there's no clawback of that, that performance TER fee. I would say doing it in sandbox is an interesting idea, but that's second part is that I think we are overly focused on equity funds because that's where the benchmark is for the most part. A liquid fund, like there's a ETF called Liquid Bees. We use it. A lot of people use it. But the fee that's being charged for a liquid fund that just deploys its money overnight is 0.69%. In fact, it went up from 0.6% recently to 0.69%, which is ridiculous. I mean, this is the highest cost liquid fund in India, period. And yet, I don't think people are designing the framework of TER to say, oh, you know what? Why are you charging, being able to charge so much? Aditya Birla, I talked about it. 0.22% has gone to 0.37% or 0.2 has gone to 0.37%. This is a 17 BIP increase, nearly doubling of a fee, and there is no fear or a problem with it. We have seen funds which have changed TER in the middle of their the financial year from as low as 0.5% to 1.5%. So they've literally increased it even on a direct, not just regular. They have increased it dramatically. Now, such funds, you would argue, it's an undesirable change at that level. And many of these are semi-passive in the sense, so liquid or arbitrage, I would say for the most part is semi-passive. There's not so much expertise of fund management as there is expertise of execution. For the most part, you have a very limited universe in which you can buy stuff and you're going to buy the same stuff. It's not tremendously different from what some other people can buy. Tinkering around with TER too much sounds unnecessary or not required as well. And of course, I think the focus on equity funds tends to be very high because retail is the biggest investor in equity funds. Debt funds anyway controlled because all these debt people have all these decks which say, listen, we cannot have low returns. You guys have to give us good returns no matter what.
I think we're kind of done with the main points from the proposal. So I'll just come to two, maybe if I can call it industry level comments or thoughts. The first is that you've said that people view mutual funds as a performance thing. That's how they filter. That's how they look at it. Cost does matter, but performance is key, really. So since the NAVs, I mean, I know we have issues with the NAVs, and I asked this to you a bit earlier, and the NAVs anyway post everything. What you see is what you get. So do you think that the spirit of this whole SEBI paper, while obviously an improvement over the current situation, is it missing the mark kind of in the sense that this is a minor improvement, but you're kind of not addressing, say, any core issue to the extent there are core issues. I'm not sure if there are. And I might as well ask you the other question right now, which is that how do you make the mutual fund industry, say, 10x bigger? And it is surely just by focusing on the TERs, which are relatively low compared to at least everything else I've seen, surely that's not what's keeping this industry back. So just these two sort of ending questions for you.
This is a great point. In fact, I think we should have a separate podcast itself on how the market should grow 10x from here. But you're right. in that TR already is included in the performance. The brokerage is included in the performance. So you're going to look at the performance and choose a fund, not the TR, right? So if that is the case, like for instance, we've done a show on index funds. We said that even in index funds, what they tell you, oh, there's a fund which is only 0.06% fee. That is meaningless. 0.06% that fund charges, say a fund like, let me give you an example. There's a fund, the SBI, India's largest mutual fund is the SBI Nifty 50 ETF. It charges 0.06%. Fantastic, you think. That means if the Nifty goes up 20% in a year, you should get 20% minus 0.06. That is how the US works. You'll get exactly that much. That's not true in India. In India, you will get 20% minus 0.15 or 0.2%. So that means you're not paying 6 basis points, you're paying 15 or 16 basis points. That's 2.5 times higher than they advertise. So I don't care about the TR. I care about the performance. What the performance does is what I would like to get. And if the performance already includes the TR, then so be it. If your TR is 14%, I don't care. If you give me a better return than another fund that's TR is 0.1%, why should I care, as long as I understand the philosophy of why you gave me that 14% or whatever it was? Because you need to keep me excited. You need to give me better performance year over year. Now, I think mutual funds should be looking to explore different avenues. So, for instance, there's a whole stock lending mechanism. Stock lending is where you can lend your stock and somebody pays you a fee for the small period, maybe 1 month, maybe 2 months, that they take the stock over. Now, mutual funds are allowed to do this, except there is no disclosure on how much they've done and what they've done and whether they're doing it. Every single mutual fund should be putting every single of its, say maybe not every single, but say 10% of its stocks. Because you know what, you're not going to get a turnover of 10% on any given day. So assuming that 10% of your portfolio, and in Kotak's case, it may be 3,700 crores because that's 10% of 37,000. You should be able to put that out for lending. And if somebody bids, that's great. If somebody does not, that's just a bid that's put in out there. Any income that's earned from it. In the US, the AMC keeps it. In India, the fund makes that as part of its return. So an AMC could charge a higher TER if it were doing these things with the idle balances as well, right? So you've got stock lending, you don't get a negative TR in the sense you don't say that, oh, you know what, I've earned so much money from you, so why don't I keep the money I've earned and I won't charge you any TR. You're not allowed to do that. You have to charge a positive TR and give any money that is earned as a result of this back into the fund itself. Now, I would say here that there are other things. For instance, mutual funds can't borrow and short stocks. That sounds illogically too much. Mutual funds cannot lend out their bonds for cash. It's a weird thing that happens. There's something called CROMS, a corporate repo. Currently, mutual funds can give their, in the CROMS network, which is managed by CCIL, I think, they can lend out their cash and take bonds as collateral. But many times, foreign banks want to short Indian bonds. They borrow the bonds and give cash. Now, what happens in sometimes some of these cases, it's a very strange setup, is that sometimes when a bond is being shorted really badly, the demand for bonds is so much that people are willing to give you money for as low as 0.1% interest rate. So you can take the cash, you have to pay 0.1% overnight. You can take the cash and deploy it on TREPs or something that's overnight for 5.5 or 6.5% and make the difference. The difference is earned by the mutual fund investors. You can do this, except currently there are a bunch of rules that don't allow them to do this, including RBI's rules. So it's not just SEBI. But I think focusing on that, where there are more earning avenues for this thing, and of course now there's an AMC repo that's coming in, and that might help solve some of this problem, but not all of it. I think that is where the core of this growth process can be. I also think that the economies of scale at the distributor end should be addressed, in the sense of, if they have reached a certain amount of scale, we should be outraged that they are not reducing their take rates. And the SEBI chairperson actually said that she does not want to destroy the TR, the sell side part of the industry. But I don't think you should destroy the buy side part of it either. Buy sides are mutual funds, sell sides are typically brokerages and all of that stuff. It's not to hurt them, but it is to enhance the power of the industry. I don't think the distributors in this piece should be allowed to charge 2x or 3x of what the actual underlying fund charges. And I would say, you could do other small things like have interesting things. Like I said, shorting stocks, like doing futures, doing options with leverage, option spreads, where option spreads don't actually have, you cannot sell options for more than, other than in covered call kind of situations. But why shouldn't you be able to take option spreads? Allow mutual funds to create schemes which have a minimum of, say, 10 lakh rupees. To invest. And in those 10 lakh rupee schemes, allow these, these option spreads and short selling to be allowed as a mutual fund itself. I think that is more something that will enhance our markets. It'll allow more people to come in because you'll have varied instruments. Some of the richer people can focus on the more exotic products. You'll have plain vanilla for something else. Mutual fund can earn larger fees on AUM that is generated by some of the more exotic products. And of course, you have like things like commodity mutual funds, which can use derivatives and so on. So I would say the TER changes, if it results in only 0.1, 0.2% extra return for investors, are not going to be meaningful. We need better thought processes, and maybe discuss this over another podcast to get better ideas out of the system.
One final push. It's almost like a counter to what you're saying. So maybe it's the wrong note to end on. But the point is, look, I know for a fact, and mutual fund distributors have said this, there's like people from insurance companies or just banks to open maybe FTs or whatever it is, and chit funds. They pay so much more. So is it any surprise that mutual funds aren't growing as fast as, say, as you would like them to? So, I mean, I know that you've had your pushback against large distributors, and maybe that doesn't impact this because they're growing as fast. They grow by 20% a quarter or whatever anyway, right? I mean, that's the deal over there. But maybe my point here is that how do you grow, and you can punt this to the next podcast, but how do you grow this by 10x in, say, 10 years, the mutual fund industry by 10x in 10 years, if you don't have more money to pay out to the people where are the incentives? Where's the, how do you motivate?
This is bang on, because you know what to promote. I think at a very core level, I even believe that. So UPI got big because players got to give cashbacks. They said, use UPI and we'll give you a cashback if you use it. They gamified it. You can't do anything of this sort with mutual funds. Why can't you do it with small ones? I'll give you a 10 rupee extra bonus if you keep investing with me. Now, the 10 rupee extra bonus is not going to change your life or mine. We are relatively more affluent parts of this ecosystem. But a lot of people will come in for that extra 10 rupees if this means that they invest 1,000. And that 1,000 can be locked in for 3 or 4 years when that 10 rupees is paid out. That's perfectly fine. But you're not allowed to do it in the current ecosystem. It's just not allowed. Second one is distribution commissions. I think small distributors should be encouraged more and more. You should have more and more people coming into the distribution scenario and saying, I'll pay you a high commission if you bring in people, and let them grow to a certain size. And beyond that size, curtail how much they can earn. But I would say our competition for them is the small distributors looking at it saying, I'd rather become an insurance broker.
Then go around selling this for like what?
For pennies,
0.7%.
Right? Over there, if I get the same 5 lakh rupees as premium, I make 20% as my commission.
Very hard to compete.
You can't compete. We are discussing 0.4 versus 0.3, and there they're discussing 20. So, it's not even a starting point. Also, distribution has much more incentives to mis-sell. So, if you give them products with extremely high commissions like in insurance or, things like chit funds and things like that, there will be those incentives that continue. I would say proposals to reduce TER by only 0.1 or 0.2%, not magnificent. I think increasing disclosure is a great idea. But I think we should look at bad practices and try to solve them. And I think bad practices can be solved within the industry itself. But regulatory stoppage of it, like disclosure of brokerage or things like that, I think will improve the quality of information available at the mutual fund level. And I think people aren't investing in MFs because of some of it is a trust problem, but some of it is also the access problem. Some other mutual fund recently started a 10 rupee SIP. Now, as Capital Mind, we probably can't do that, right? Because we have only one business, which is the AMC itself, which is an asset management business. And if somebody did a 10 rupee SIP, it costs at least 2 rupees to process an SIP. That's a 20% TER. Nobody's going to allow that. How does this particular mutual fund get away with a 10 rupee SIP? Is that they take this 2 rupee cost in some other subsidiary company, which is not even related to markets. Like, so, oh, they're our distributors, they're taking the cost, we're not. So, but why aren't they? If 10 rupee SIPs work and somebody is willing to take the cost, why aren't they willing to take the cost? Why aren't they being allowed to take the cost? The current rules say if you spend 2 rupees to get an investor in a mutual fund as an AMC, that cost needs to go to the fund itself. And TER caps means you cannot take that cost. That means the 10 rupee SIP can never happen. Now, it took a convoluted ownership structure to make this happen. It doesn't need to be that way. I think if we address that, we'd get more people into the ecosystem without bringing TER as the defining factor of why, people don't come in here.
Well, Deepak, that's a tantalizing note to end on. So we'll keep the next episode more interesting and more open-ended than that when we talk about how to grow mutual funds. Whenever we get around to recording that, maybe if and when we get approval, we can have that chat.
We keep talking about it internally as well. So I think it's more fun to kind of get thought process from others. Anybody else has thought processes, please look us up and tell us what you think.
Yeah, so to look us up, visit capitalmind.in to see what we write about, see what our premium offering is, capitalmindwealth.com to learn more about our PMS, where if you have more than 50 lakhs, we can invest your money for you in stocks, mutual funds and the like. And finally, if you have any feedback, suggestions or comments, just email us at podcast@capitalmind.in. We do review that fairly regularly. So thanks for listening in. Bye-bye.